Will Berkshire Hathaway ever pay a dividend? Many investors wonder about this, given how much cash Berkshire hoards on its balance sheet. As of the last quarter, its cash position increased to over $334 billion. That's a staggering amount. Most of it sits in liquid short-term treasury bills. In this video, I want to understand why this cash hoarding is happening, and will ever Berkshire initiate a dividend policy? Lately, short-term government bonds provided a relatively attractive return of 4 to 5%. In its latest income statement, Berkshire reported a staggering $13.7 billion in investment income from its insurance business. The bulk of it is the interest from that mountain of treasury bills. Overall, Berkshire had a very good year, with its earnings growing to $47.4 billion, a 27% growth. One thing to note is that almost half of this cash hoard is in insurance float. If you don't know what an insurance float is, it is a secret edge of Warren Buffett. I made a video linked here where I explain in great detail what this cheap source of capital and its significance for Berkshire. Float is money that consists of insurance premiums paid net of payouts. Berkshire deploys or used to deploy this capital to invest it in publicly traded stocks, but now it mostly sits in treasury bills, earning 4 to 5% interest. Why would Buffett hoard so much cash? There are several explanations, and an obvious one is that Berkshire cannot find suitable investment opportunities. And given the size of Berkshire, only large cap companies can make a difference for its performance. Here's Buffett acknowledging this problem in his recent letter. With marketable equities, it is easier to change course when I make a mistake. Berkshire's present size, it should be underscored, diminishes this value option. We can't come and go on a dime. Sometimes a year or more is required to establish or divest an investment. Buffett mentioned that his preference is to invest in American stocks. He underscored in some of his remarks that the great majority of investors' money remains in equities. He also mentioned that while the exposure to marketable equities moved down, the value of non-quoted control equities increased somewhat and remained far greater than the value of marketable portfolio. Some people speculated that Berkshire's recent move to reduce its stock exposure was driven by tax considerations. Namely, Buffett expected higher tax rates on corporate profits in the future, so he sold off some of its holdings. But now we know that with Trump and Republicans winning the elections, this is probably out of the window. So why sell and not invest in public stocks? Is this a warning from Buffett that he sees a large cap segment of the market as largely overvalued? We don't know for sure, but many things point in that direction. For instance, Berkshire returns capital to its shareholders by buying back its shares. As you know, they have no dividends. Buffett's buyback policy before 2023 was to buy Berkshire stock when it was trading below 1.2 of its book value. But we see that over the past 5 years, Berkshire price-to-book ratio has been consistently above 1.2 times. At this point, it hovers above 1.5 times. For this reason, Buffett amended his buyback policy in 2023. Now, Berkshire can repurchase shares when its stock price is below Berkshire's intrinsic value, conservatively determined. Buffett has been a consistent buyer of Berkshire's shares, but last year the buybacks faltered. In the last 2 quarters, they were pretty much non-existent. So this leads to the question of dividends. How likely are they, given that the share buybacks don't work? Will that ever happen? Let's examine the history of Berkshire and Buffett's views on dividends. Buffett loves receiving dividends from other companies. They're an integral part of Berkshire's returns, but he doesn't like paying one to Berkshire's shareholders. Here's what Buffett said on this.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off if we retain the money. Because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out.
So as we see, as long as Berkshire can earn more on each dollar reinvested, its shareholders are better that way. And paying dividends would deprive Buffett of a valuable capital that he can deploy profitably elsewhere. There was a notable vote cast about 10 years ago on dividends from Berkshire, and by a wide margin, most shareholders opposed this action. So true, maybe since then shareholder base has evolved. But still, the way I see it, it seems like most shareholders of Berkshire oppose dividends and prefer reinvestment. It's not hard to imagine under what scenarios Berkshire will start paying dividends. Even Buffett himself acknowledged that one day this will happen. As we see, for buybacks to make sense, Berkshire's stock price must be below its intrinsic value. There could be moments when stock price is too high, like it is now. Then cash hoard accumulation accelerates. On top of it, short-term treasury rates may not stay high forever. There could be interest rate reductions on the table soon. So in that case, the treasury rates will not be as high as they are now, like 4 or 5%. And so the returns may not be that attractive for that cash hoard that Berkshire holds. And so maybe in that case, it may make sense for initiation of dividends. Based on my number crunching, here's what I see. Berkshire can sustain a small dividend in the realm of maybe 1 or 2% with some buybacks. But the thing is, the dividends and buybacks will compete with each other for capital. So in a sense, you can't really withdraw a dividend, so buybacks will have to be curtailed. And that's a negative, because buybacks are more efficient tax-wise to return capital to shareholders, as they face only 1% tax rate compared to something much higher for dividends. So for now, it doesn't look like dividend is on the table for Berkshire, at least in the near future. Although, judging by the market reaction to some of the dividend initiations, like from Meta, it could be taken very favorably. So for now, Berkshire will likely still pursue its reinvestment of earnings and buybacks when it is favorable. If you would like to learn more about Buffett's 2 ETF portfolio, watch this video next. Also subscribe to my channel for more insightful content on investing, personal finance and more. And I will see you next time. All the best.